So guys, dividend growth is what we're all about. We're not just looking for stocks that pay dividends, we also want our stocks to grow their dividends over time, because the end game here is to build a stream of passive income that's constantly getting bigger and better. Now, the reality is, with most dividend stocks, you'll notice something over time. Their dividend growth rate tends to slow down. Now, they might still be bumping up their dividend payments year after year, but the pace will start to lose steam. But that's not the story with the 4 dividend stocks we're talking about today. These aren't your average dividend stocks. The dividend growth rate on these bad boys is actually speeding up, so much so that I'm calling these stocks dividend rockets. And in this video, we're going to break down these 4 stocks and take a look at how they're rewarding shareholders with dividends that just keep growing faster and faster. But before we get to those, guys, I want to hear from you. Leave me a comment below and tell me about your favorite dividend growth stocks. I would love to hear about which stocks you guys are liking, so definitely let me know. All right, guys, now this first stock on our list today is a company that I haven't talked about for a couple of months, but it's one that I really like. In fact, if you guys keep up with the newsletter at all, this was my top dividend stock pick for June. We're talking about Old Dominion Freight Line, ODFL, which is one of the country's leading trucking companies, and they specialize in what's referred to as less than truckload, or LTL operations, which typically pick up multiple shipments from multiple customers on a single truck. From there, the LTL freight is then routed through a network of service centers where the freight may be transferred to other trucks with similar destinations. Now, in total, Old Dominion has 260 service centers across every state in the continental US, 90% of which they own. But at any rate, this LTL structure seems to be working incredibly well for Old Dominion, seeing as the company has been a pretty aggressive grower over the years, judging by the charts over here on Snapstock, which is a new stock analysis platform that I've been working on these last few months, guys. And it's not available yet. We haven't officially released Snapstock to the public, but that should be coming sometime in the next few weeks or in the next month, sometime here in September or possibly in October. And every single week I'm sending out email updates regarding Snapstock and all the latest developments. So if you're interested in checking out this platform, just sign up to the waitlist linked in the pinned comment. But anyway, back to Old Dominion, guys. Like I was saying, this has been a very aggressive grower over the years. And we can tell that just from looking at these charts here. All of these are straight up and to the right. And the revenue CAGR over the last 5 and 10 years has been about 10%. That's really nice. The earnings per share has grown by, over twice as much. And the free cash flow has seen some very substantial growth as well. And growth in all of these departments is a great sign for us investors who are on the hunt for great dividend growth stocks. This is exactly what you want to see. And not only is Old Dominion growing their sales, their earnings, and free cash flow, but their profit margins are also increasing, meaning that this company is becoming more profitable over time. And if we start here with the gross margins, we can see that in the last decade, it's gone from being, in the mid 20% range to really creeping up there and now sitting comfortably in the mid 30% range. So this is looking really good. And then the net income margin is seeing a very similar trend as well. It's actually doubled over the last decade. 8, 9, 10 years ago, it was about 10% on average, we'll say. Nowadays, it's over 20% comfortably, so that's a great sign. And the free cash flow margin has probably seen the most aggressive growth since then. 8, 9, 10 years ago, we weren't even hitting 5%. But nowadays, guys, that's like tripled, and now we're hitting 14.6%. 14.6% yet again, and then, about 14%. So all of these are looking great. Now, as far as the dividend stats go, and more specifically the dividend growth rates, I will admit the slope on this dividend growth rate is not going to be the steepest. The dividend growth rate is increasing over time. It's definitely there, but it's very incremental. And this is the chart we want to look at here. Now, on an absolute basis, this all looks really good. There's not a year in the last 5 years where they haven't increased the dividend by at least 30%. But like I said, the dividend growth rate, the increase here is very incremental. It's there. We've gone from 30% in 2018 to 30.8% a year later. Then a year later, in 2020 even, we jumped up to 33.1%. Then the next year, it saw a slight little dip, 32.6%, but still overall we're trending upward. And then a big jump in 2022 at 50%. And now it's back down in 2023 to 33.33%. So overall, yeah, I think Old Dominion is still a dividend rocket. We're seeing that dividend growth rate increase over time. Now, one more thing that I do want to look at is the payout ratios here. And starting here with the earnings payout ratio, we can see that this has been trending up over time. It's not super alarming. It's only gone from 7% back in 2017 to now 15.7% in the trailing 12 months. So that's not really bad, but you will want to keep an eye on how this is trending. Now, if this trend continues in perpetuity, if the earnings payout ratio just keeps going up and up and up with no end in sight, that's not a good sign sign, and that doesn't bode well for the dividend. But in Old Dominion's case specifically, even though the earnings payout ratio is trending upward, this is far from being something that we should be concerned about because the payout ratio is still only 15.6%. There is still plenty of room to continue increasing this dividend and increasing the payout ratio if they need to. But if we see this for some reason get up to the 70, 80, 90% range, then, that's probably going to be a red flag for us. And now jumping over to the free cash flow payout ratio, we can see a similar trend here. Since 2019, the free cash flow payout ratio has gone up, but it's a similar story. Like at the highest, it was 43.4% in 2023. In the trailing 12 months, it's even lower, about 33%. So the dividend still looks very well covered just based on these payout ratios. Now, as far as whether or not Old Dominion is a good one to buy right now, I think it's kind of tough to say. Looking at the share price performance, right now it's sitting at $196 per share or so. In the last month, it's down 3%. If we zoom out looking at the year-to-date performance, it's just barely in the green. It's up a little bit, 2%. And if we can zoom out once more, looking at the last 365 days, it is down. It's still down 7.25%. But still, with that, if we look at some of these valuation metrics here, the PE ratio, 33.3. This is a pretty high PE ratio, but Old Dominion's a pretty growthy company, so maybe this PE ratio is justified. But what we want to look at is the difference to the 5-year average. So the current PE ratio is about 13.4% above the 5-year average. So just based on this, a little bit more expensive than usual. We're seeing a similar trend here in the price to free cash flow. This is about 5.2% above the 5-year average, and that's a very high price to free cash flow. And both the earnings yield and the free cash flow yield are quite a bit below the 5-year average by 16.8% and 13.85% respectively. But like I said a moment ago, Old Dominion has been a very aggressive grower. We saw that in the growth charts. It's becoming more profitable over time. This is a very high quality business, and so I would imagine that still, even at current prices, just under $200 per share, if you bought at today's prices and just held on for a long period of time, I'm sure you'd end up doing just fine. But anyway, guys, now moving on to our second stock of the day. I've been talking about this one quite a bit these last couple of months. I actually just recently made a video on it a few weeks ago, and it was also my top dividend stock to buy in April. That's right, guys, we're talking about Zoetis. And unlike what we saw with Old Dominion, the slope on this company's dividend growth chart is much more noticeable, and it's undeniable that Zoetis is a dividend rocket. Looking at the chart here, we can see that 2014 to 2017, the company did see their dividend growth rate slow down, but on an absolute basis, it really wasn't bad. The lowest dividend growth rate in this time period was still 10.5%, which is very solid. And since then, the dividend growth has picked back up. We can see that 2017 to 2018, we see a 20% dividend growth rate, so it doubled in this year here. Then going into 2019, we get another 10% boost, and the dividend growth rate was over 30%. 2020 was down a little bit, but then we jump back up in 2021 and in 2022, where we saw another 30% increase. And then 2023 was another down year. But looking at this trend right here, guys, this is undeniably going up. And then along with this, guys, right now, if you bought at current prices, you'd be able to lock in a higher than average dividend yield. In the trailing 12 months, it's sitting at 0.9%, which is about 0.25% above the 5-year average and 0.2% above the 10-year average. So either way, you're getting a higher than usual cash flow return. And if we scroll down looking at the payout ratios here, kind of like with Old Dominion, we do see this trending upward over time, but once again, nothing to be concerned about. In the trailing 12 months, the payout ratio is still only 31.6%, so still plenty of room to continue paying and growing that dividend. And the same is true here with the free cash flow payout ratio. Since 2017, it has been on the up and up, although since 2022, it has kind of made its way down, and in the trailing 12 months, the free cash flow payout ratio is only 36.2%. Now, obviously, guys, the level of dividend growth and consistency that we see here with Zoetis wouldn't be possible if the company itself wasn't growing. And looking at the growth metrics, this is pretty similar to what we saw a moment ago with Old Dominion. The revenue is straight up and to the right. Over the last 5 years, the CAGR is about 8.2%. The earnings per share, once again, is straight up and to the right, and the 5-year CAGR here is even higher than the revenue. And then the free cash flow, once again, straight up and to the right, guys. This is just a work of art. This is beautiful. And in my opinion, these growth metrics here are exactly what you should expect based on what Zoetis has going on in the dividend department. And I talked about this in my video from a few weeks back, but I'm still kicking myself for not picking up some shares of Zoetis when I first started talking about it back in April. Taking a quick look at the share price performance, right now Zoetis is sitting at about $182 per share, and it is down here year to date. It's down about 4.8%, so it has seen some decline still in 2024. But back in April, guys, it was much lower than where it's at today. It was about $145 per share here on April 22nd, and so clearly since then it's seen a pretty nice run up. I wish I would have bought some shares back then, but still it's really not too bad now. The PE PE ratio actually is a bit higher than what we saw with Old Dominion, so 35.7, but this is a bit lower than the 5-year average, interestingly enough. The price to free cash flow is also high, 39.55, and this is also quite a bit below the company's 5-year average, so these are promising signals here. And the earnings yield and the free cash flow yield are both above their 5-year averages, but still 2.8%, 2.5% for the free cash flow yield. These aren't the highest yields. Overall, though, I still think Zoetis is a very high quality company. It's a definite dividend rocket. And, there's still a chance that I may add it to the portfolio at some point. I'm not sure that I want to do it today at current prices, but I do really like this company. Same with Old Dominion, actually. I wouldn't mind owning either of these companies at some point, and both of them are on my watch list, and so are the other two stocks we're talking about today, with the next one being Watsco, which is a very under-the-radar company, guys, and not a lot of people talk about Watsco, but more people should, because despite it being a pretty boring business, it's a beast. Watsco is a distributor of HVAC products, so they deal with things like heating, air conditioning, and refrigeration, which obviously is essential for any property, whether it's residential or commercial. People will always need to keep their homes and their businesses at a comfortable temperature, no matter what's going on in the economy, which makes Watsco relatively recession resistant. It's a good all-weather stock to own. Even during economic downturns, people prioritize repairing or replacing their HVAC systems. It's just not something you want to go without, especially during a crazy cold winter or a sweltering summer when things really start to heat up, which I think is actually the perfect segue into the company's dividend stats, because things are really starting to heat up there. But I will say this chart is a bit more interesting than the last couple of companies we've seen, because as we can tell here, for the better part of this last decade, the dividend growth rate was slowing down all the way here into 2020, which is where things look to have bottomed out. And even at this point, it's not bad. In 2020, they still raised the dividend by 8.2%. But since then, guys, the dividend growth rate has started to pick back up. From 2020 to 2021, we get to the double-digit range. Moving into 2022, we're a little bit higher at 12.1%. Then in 2023, we jump up to 14.6%. So overall, it looks like Watsco is getting a sort of second wind in the dividend growth department. It looks like they're starting to see a resurgence here. But as far as the yield goes, right now it's sitting at 2.25%, which is not too bad considering the dividend growth stats. I think these are pretty standard dividend growth stats overall, but the yield, as we can see from the chart here, is a bit below both the 5-year and the 10-year average. It looks like historically the yield sits at about 3.5%, and it's quite a bit below that right now. And if we scroll down here looking at the payout ratios, this is kind of what I was talking about earlier, where the increase in the payout ratio would be something you'd want to keep an eye on, because for Watsco, from 2014 to 2020, it goes from being, 46%, which is not a bad payout ratio, but it goes from that to steadily increasing over the years to the point where in 2020 it was almost at 100%, which, considering that, it's no surprise that we saw the dividend growth rate slowing down in this period of time here. But from there, it looks like it's starting to normalize and it's coming back down. It's still, I would say, on the higher end, so I'm actually kind of surprised that their dividend growth rate is picking up, because the earnings payout ratio is a bit higher than what I'd like to see, 76%. That doesn't leave them much wiggle room, and I'd love to see it get down to, maybe 55%. If they can lower that over time, that'd be a really good sign. With that, though, the free cash flow payout ratio still looks to be in really good shape, and this has never really been cause for concern except for here in 2018, where it was over 100%, but otherwise it's been okay. The highest year since then was 82.6%, and it looks like it's making its way back down, and in the trailing 12 months is actually below 50%, so this looks fine to me. But then switching gears and looking at some of the growth metrics, this looks, once again, kind of like the last two companies we've seen. The revenue's been straight up and to the right, the earnings have been straight up and to the right, and once again, just like the last two stocks, the earnings per share is growing faster than the revenue, so that's a good sign. And then the free cash flow has also been growing at a pretty aggressive clip as well. According to this, over the last 5 years, it's grown by an average rate of about 20.5%. And like I said earlier, Watsco is currently on my watch list. It's been on my watch list on and off, I would say, for the last couple of years. I've always really liked this company, but the problem with it is it's one of those companies that just doesn't seem like it does anything but go up. I mean, today it's seeing a bit of a drop. It's down 4.2%, but we can still see year to date is up 13.5%. If we zoom out over the last year, it's up 33%. Guys, just not even a year ago, it was sitting at $330 per share. Now it's almost $460. If we zoom out once more over the last 10 years, guys, it's really taken off, especially since 2020 here. So the pandemic lows were about $130 per share, and it's really just gone up a lot, a crazy amount since then. And recently too, even in the last year and a half or so, it's really shot up. It's almost doubled in the last year and a half, actually. But anyway, guys, with that, now moving on to our fourth stock of the day. this one is actually a pretty similar business as Watsco. We're talking about Pool Corporation, ticker symbol Pool, which like Watsco is also a distributor, but Pool Corporation deals in swimming pool supplies, which you probably could have guessed based on the name. And this company is actually the world's largest wholesale distributor of pool supplies with around 440 locations worldwide. And jumping over to the dividend stats, the trend here on this dividend growth chart is pretty clear to see, guys. It's pretty much straight up and to the right, with the exception of 2020, which we'll give them a pass for. But even in this year, they increased the dividend by 9%. And in 2023, this was the other down year, but still they increased it by 13.2%. And despite these 2 years, the overall trend is just straight up and to the right, a definite dividend growth rocket. And then looking at the growth metrics, it's probably no surprise, but all 4 of these companies have very similar looking charts. Revenue straight up and to the right, earnings per share straight up and to the right, free cash flow per share straight up and to the right. So all across the board, that's looking pretty sweet. And the price right now really isn't too bad either. Looking at the share price performance, just today it's down 3.4%. And the last month it's down 4%. Okay, year to date, Pool Corporation is down 8.4%. And in the last year, it's down another 4% here. And really, these valuation stats don't look too bad. The PE ratio is 28.14. This is the lowest that we've seen today. And this is once again a very growthy company. So that's not too bad. And this is also 8% below the company's 5-year average PE ratio. The price to cash flow is also, I believe, the lowest we've seen today at 21, and this is almost 50% below the 5-year average. And then the earnings yield and the free cash flow yield aren't too bad either. I mean, this is a pretty nice free cash flow yield at 4.76%, and this is about 50% above the 5-year average. So overall, Pool Corporation does look to be relatively cheaper than usual, so it could be a good one to consider buying right now. And with that, if you're in the market for some more good-looking stocks to buy right now, then check out this next video right over here where I'm telling you about 3 of them that are deeply discounted and all look like great pickups right now in the month of September. So click right over here to check those out, and I'll see you in the next one.